Welcome back to Market Domination Overtime. Stocks ended the day higher as Bitcoin falls back below 90,000. And as the S&P 500 has climbed over 16% this year, the cryptocurrency is down about 3%. This is the first time in 10 years that Bitcoin has split from stocks, according to Bloomberg. Joining us now with more is our very own Inez Ferre. Inez.
Yeah, Josh, as you just mentioned, Bitcoin down for the year. Meanwhile, you've got the S&P 500 that is up for the year. So if we just take a look at Bitcoin and we put up a year-to-date chart, you'll see it's down 5% year-to-date as of right now. That's because Bitcoin is down around 89,000, down more than 3% over the last 24 hours. So this is the first time since 2014 that this has happened. Traditionally, you see Bitcoin moving in tandem with stocks. But as you can see, from the all-time high in October, you are watching Bitcoin that's down about 30% from that all-time high of north of 126,000. So it's been quite a fall that we've seen with Bitcoin, and it has been losing out. We've seen outflows of ETFs. And what strategists are saying is that investors are going towards the metals. I mean, the momentum really has been in the metals market. So the question is, look, Bitcoin, crypto has gotten everything that it's wanted this year as far as regulation. The Clarity Act is in Congress, so the Trump administration is behind this. But what will send crypto higher going into next year? Well, we do have the Fed easing, and that's expected to be bullish for crypto. And you also have the Clarity Act in Congress. But just taking a look at the difference between what we've seen with crypto and what we've seen, for example, with gold, as I mentioned, gold is the second best asset right now. Year to date, it is up nearly 60%. The first being silver, that's up almost 100%. We have seen momentum going into gold and going into silver, especially over the last several months. And so what strategists are saying is that, yeah, you've seen that shift. Traditionally, though, or historically, what some strategists, what some bulls for crypto are saying is that when you see gold going higher, that tends to front run crypto. So the expectation is that as we have seen gold going higher and higher, then this would be bullish for Bitcoin. Josh?
All right. Thank you, Inez. Well, Deutsche Bank releasing its 2026 U.S. equity outlook, and the message is upbeat. The team sees a powerful backdrop pushing the S&P 500 toward 8,000 next year. For more, we're bringing in now Parag Thatte, equity strategist at Deutsche Bank. Parag, it is great to see you. So let's start right there. So as we head into the new year, Parag, you see the S&P 500, it's going to go to 8,000. That's your target by end of 26. What gets us there, Parag? What are the drivers you see?
Thanks, Josh. And so the crux of our thesis is that the cycle has a lot of legs to continue. So we think earnings growth, which has already been strong, will continue to be strong. We expect about 14% growth next year. And more importantly, we think that growth will start to broaden out across sectors.
Why do you think that, Parag, that it broadens?
So we are already seeing the broadening out in the third quarter. We saw many signs of other sectors beyond tech and the mega cap growth stocks seeing a pickup in growth. So in the second quarter, for example, when these two sectors had seen growth in the positive territory, in the third quarter it was 6 sectors. But there are many other signs that we saw growth is already broadening out. And because of a lot of headwinds sort of abating from this year to next, we think growth will continue to strengthen next year. And so if our forecast is right, we expect about 14% next year, broad-based growth. We don't think investor positioning is in line with that kind of growth just yet. We think investors are positioned for growth to be in the low single digits. And so if we do get that kind of growth, we think there's a lot of room for investor exposures to go higher. We also think the cross-asset boom in inflows that we have seen helping equities in 2026. And if earnings remain strong, we think buybacks will also remain strong. So when you put all of that together, we think that points to about 14% gains for the S&P 500 next year, which takes you to about 8,000.
I've had other strategists, Parag, sitting in that chair right there, who say they're a little more cautious, in part because of valuation. And so I'm curious how you characterize valuation here.
So we would say valuations are high by historical standards. There is no question about that. We just don't think looking at the historical averages is necessarily the right way to look about it. And the simple example I would give you is that if you look at a company and you try to evaluate whether its valuation is okay, you will look at the drivers of valuation. What are its payouts? What is its earnings growth? What kind of earning stability does it have? And so on. So those same kind of drivers which work for individual companies also matter for the market as a whole. And so we have a lot of drivers which have moved in a positive direction, which have pushed valuations higher. So payout ratios are much higher than they used to be. Earnings growth has been much stronger than over the last decade than it used to be. And earnings have been a lot more resilient than they used to be. So when you take all of that into consideration, so 25 times last year's earnings is high. So there's no doubt about that. But we think it's very reasonable. And in fact, if you look at the drivers, you could even get valuations to go even higher from here. That is not our forecast. That is not what we are calling for. But it won't be a surprise if that does happen.
So when your clients ask you, Parag, right, you're constructive generally, and they ask you, what are the risks? Is it the economy, Parag, inflation reaccelerating? Is it policy uncertainty? What do you tell them?
So policy uncertainty was the biggest issue for 2025. There was a optimism coming into the year, and that got whacked by the tariff uncertainty, especially. But going into next year, we would remind that there is the midterm elections coming up at the end of the year, which means policy uncertainty, any policy that hurts growth or increases inflation is unlikely to sustain for a long time. So if there is any policy which causes the markets to get spooked, we think those policies will get rolled back because there is that fear of the midterm elections and maintaining sort of approval ratings ahead of that.
How many Fed cuts does your team pencil in for 26?
So our economists expect the Fed to cut in December and then go on a long pause into next year all the way out to September. So our bullish view on equities... So
pausing until next fall?
Yes. And so our bullish view on equities is not based on the Fed cutting. And the way we look at it is the Fed rates are a reflection of the cycle and not a driver. And the reason why they expect the Fed not to cut next year is simply because they expect growth to be picking up. And so if growth is picking up, we think that is much more important for equities than the fact that they are not cutting interest rates.
How important is that mega AI trade and trend to your theme?
We think that trend continues. There are a lot of concerns around how much the tech companies are spending, that the capex has gone through the roof of the charts and so on. We think that those concerns are overblown.
You do, because there's some people, Parag, who've said they are concerned that maybe we're overbuilding data centers here.
Right. The thing to keep in mind is that their capital spending has been growing at a very, very fast clip for more than a decade, even prior to the AI boom. So it's been growing at about 12-13% a year, all the way back into the early 2010s. And so, if you look at the tech capital spending in 2022, before the AI boom, for companies globally, it was about 550 billion, 600 billion. And growing at 12-13% a year, which was the trend rate for a decade before, you would have expected it to be about 800 billion this year, which is exactly where we are. So we would say that the tech spending so far is about in line with the prior up cycles. And if the AI boom is that huge an opportunity, we think we are still in the early phase of the upcycle in tech spending. We are not stretched yet.
Parag, I'll end here. Bottom line for investors who are watching. The sectors you want to stay over in 2026, what are you telling clients?
So we like financials here. A lot of tailwinds from expected loan growth is picking up, deals are picking up, capital issuance is picking up. We don't think all of that is priced into the stocks yet. We are also positive on the industrials, a lot of secular themes within industrials on power demand in aerospace and defense and so on, but also a very easy option sort of to play the cyclical upside as manufacturing picks up more broadly. And then we also like healthcare. A lot of policy headwinds this year, but we think we are past the peak of those policy headwinds, and so there's a lot of upside. We have seen this sort of story play out in the 1990s when there was the first attempt at healthcare reform. Again, in 2010, around the ACA, and we think this is the third sort of this big policy headwind that we are working through.
It's interesting in healthcare because traditionally you would say, okay, I'm going to move into healthcare because valuation, safety, I want to get more defensive. Is that still the reason, or is that changing?
I think applying like this, the tide lifting all boats in a cyclical manner, I think that sort of theme is not working in this market, because there are so many different themes running at the same time that you cannot have just one sort of simple story to play. So healthcare has been whacked for very clear reasons. They had the pandemic sort of the digestion phase when they had a big boom during the pandemic coming off it. Then they had the policy headwinds. We are going past that. So that's the main reason. On the other defensives, we are a lot more cautious. One, because we think the cycle will continue. So, you know, in that phase, you want to be more cyclical. But also, we think for the defensive companies, they have an issue with their costs having just gone up way too high, the prices having gone way too high. Plus, with our house view that there's only one rate cut coming in December, and our rate strategists actually think that bond yields might pick up from here. With that sort of a backdrop, the bond-like defensive sectors is not where you want to be.
Parag, great to have you on the set today. Thank you, sir. Appreciate it.
Thank you.
Well, Tesla is expanding its lower cost lineup with Europe in mind as the EV maker now continues to see sales pressure in that region. And Yahoo Finance's Parag Thatte joins me now with more Parag.
You know, I feel very European right now.
I was going to say,
so I think
I was going to use the word sophisticated.
Yeah, I mean, I like that better.
The turtleneck, I mean, cultured.
I will say this: the new standard models that are coming to Europe now, that they're already in the U.S. Not very sophisticated, right? They're decontented models, meaning that they sort of have the seats are cloth. Decontented
yes.
is the word. The seats are cloth. The lighting is not as complex. Less powerful motors, less range. All in the name of making it a better deal, right? So in Europe, I'll look at the Dutch website, Tesla's Dutch website. The new standard Model 3 comes in around 37,000 euros compared to 46,000 for the premium, which is the one right above it, right? So that's, you know, pretty decent swing. The new model, standard Model Y in Europe is 40,000 euros versus the premium at 51. Now in the US, the difference is about half that. So that's a pretty big swing there in terms of price between one car and the other. That might maybe move the needle there for Tesla in the EU, where it's frankly having some problems.
Let me ask you this. When we talk about Tesla's weakness in Europe, what do we chalk that up to?
You know, it's a mix of things, right? We talked about before, competition, right? There's a lot of new EVs out in Europe, and more than the US actually, because there's just more charging infrastructure. You have Volkswagens, you have Audis, you have Porsches at the high end, you have even Renaults at the lower end, but then you also have all the Chinese automakers are there too, right? The Geelys of the world, you know, people, the SAICs, that they're also there, and they're competing against Tesla because they're taking away market share from Tesla, which was there in one of the first companies there, but now they're outnumbered by competition. And also, we talk about the Musk factor. He's embraced some politicians that aren't necessarily the most popular in certain markets like Germany and Netherlands and France, places like that. So that may have an effect. But things like cheaper prices and the potential for FSD in Europe might potentially move the needle. And if Elon
maybe reverse that?
Yeah, maybe if Elon kind of big if he sort of keeps quiet and just sort of sticks to business, maybe he turns around for them. But I think the price is the biggest factor.
All right, Parag, thank you, sir. Appreciate it. Time now for What to Watch. We're going to start off on the Federal Reserve, a critical moment for the Fed coming up with December's FOMC meeting. That's kicking off on Tuesday with the interest rate decision coming on Wednesday. Wall Street largely expecting the Fed to cut rates by 25 basis points at the meeting. Fed Chair Jerome Powell will be giving his typical press conference after that decision. Yahoo Finance will begin coverage on Wednesday at 2 p.m. Eastern. And take a look at earnings as well here. We're going to be getting another big batch of earnings, including Oracle, Broadcom, and Costco. Now, Oracle is going to be announcing results for the second quarter that's coming on Wednesday. Analysts expecting Oracle to be set up for another strong quarter because demand for its AI cloud is still much bigger than its available capacity, and the cloud infrastructure business could grow around 70% this quarter as more AI capacity does come online. Oracle should see strong near-term demand even before the big OpenAI contract ramps up over the next 2 to 3 years. Moving over to the labor market, we're going to be getting a beat on small businesses on Tuesday with the NFIB Optimism Index. Economists forecast that number to hold steady at 98.2, signaling a wait-and-see mood among small businesses, and that owners feel about the same level of confidence and concern as they did back in October. Well, coming up, we get Jared Blickery's biggest takeaways from today's market action. Stocks closed the week higher with the S&P 500 notching a 4-day win streak here. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways.
Josh, a number of themes have emerged over the last week or so, and one of the things I've been watching today is tech and Tesla. So let's just jump into that. I mean, yesterday it was the small caps. Russell 2000 hit a record high finally for the first time in forever. And today we got some new themes. So tech is back. We saw chip stocks kind of roaring back. I think the Philly chip index hit a record high today. So there's your tech trade. But I want to focus on Tesla right now because it is inching closer to its record high. And I'll just show you a quick 5-year chart. You can see over these last 5 years, going back to the pandemic, it's really frustrated traders. But if you kind of look at the pattern that we have here, it's almost like a big cup and handle. And then if you zoom in over the last 2 years, you can see a smaller cup and handle developing right here. So if Tesla breaks out, that is a long base. And as they say, the longer the base, the higher in space. So this could have the potential to rocket higher if we can get above those prior record highs and just kind of maintain that for a few days. So not to get too far ahead of myself, I saw some other interesting things in the market, but I don't want to jump the gun there.
Don't jump the gun, Jared. We've got a ways to go here.
Yeah.
What about the Dow transports? I saw him making some headlines.
Planes, trains, and gains. So yeah, the Dow Jones Transports Index is up 10 straight days. By the way, so is XLK, the tech sector ETF, but not a lot of people talking about the transports. So let's take a look at what the transports have been doing recently. Here you had, this is a 2-year chart. You had a nice consolidation for several months in 2025. Here's the start of 2025 right here. So this was a nice long period of time, and now it is broken out, and now it's going higher. Not quite at the records that we saw back here in 2024. Yet some of the ETFs that track transports and aren't directly tied to the Dow transports have already hit record highs. IYT is one of them, so I was tracking that earlier today. But nonetheless, transports are looking good here, and that includes a whole plethora of stocks, some of which we talk about, some of which we don't. So let's take a look at the 5-day on the Dow transports components. Uber, the biggest one that was added, I believe, last year, that was up 4.3%. Don't forget, we still have railroads in this country, and they're very important. There's CX up 2.7%. JB Hunt, not a railroad company, that's up 8%. Old Dominion up almost 15%. And then a company like Expediter, that's not Expedia, that's Expeditors right there, EXPD, that's up 3%. And the airlines too, really roaring back this week. Love, that's Southwest, that's up almost 9%. American up 5%, and Alaska Airlines 15.8%. Let's just take a look at the year to date on that. Basically dead money, but it's interesting to see some of the come behind trades. What a lot of portfolio managers do this time of year, if you're behind the index, and usually we have when the S&P is up 15, 20% the way it is now, you have a bunch of managers who are behind, they will leverage up in some small names and play the catch-up trade and try to get above the S&P into the end of the year. So I think that could be one of the things that's happening right now, and that explains why some of the very smallest names are also doing very well, and a lot of them unprofitable too. Doesn't mean they're great companies, but they're doing well right now.
What about commodities? Do you want to do a check?
Yeah, let's do that too, because B of A was just out with their weekly flow show report, and Hartnett was saying energy and crude oil could be the contrarian trade of 2026. So that's what I'm saying, is that energy's 2026 comeback. Let's take a look at some of the charts here. So first of all, let's go to the futures and track what crude oil is doing. So we're looking for CL equals up. It was up 1.5% this week, but I'm going to put a longer term view on. Let's go to 5 years. And you can see, here's the big spike. That was about $130 per barrel. That was the original invasion of Ukraine by Russia. But we're just camping out by these lows, which is almost the lowest since we've seen since like 2022. If you get some momentum here, if you're able to break out of this trend line, you could see crude oil moving higher. And to support that, commodities in general tend to do very well when the Fed is cutting, but we're not in recession. And so far we don't have any red warning flags for recession. So that's crude oil. Now let me do small oil, because that's something that has really caught my attention recently. PSCE, it's one of my leaders this week, up 5%. And similar to the transports, they just broke out of a trading range. So here we go. Boom, highest that we've seen since earlier in the year. And this is small cap energy. XLE has been bumping, that's large cap energy, has been bumping up against multi-year highs. Bottom line, if crude oil can get going a little bit, energy gets going, small energy gets going, I could see this working out in 2026.
Quickly, it's Friday. Fast check on crypto.
Yes, let's do that. My thesis on Bitcoin is that we're in a short to medium term downtrends, but we're still in a secular bull, hopefully, I think, for this decade. But 75,000 has been my line in the sand. And one of the things I've been emphasizing, let me dial this down to a 2-month chart, is that the selling that we've seen has been very technical. So whenever we get a bounce, and I'll put some candlesticks on here, like this latest high right here, that was an exact 50% retracement of, I think, this level right here. So you have, when you see very technical selling in a big market like Bitcoin, that just means whoever is obeying those technical signals has the edge, and that would be the shorts right now. So until I see some of the technicals favoring the longs, and until I see some longs setups really getting played out in this market, I'm not going to turn bullish.
All right, thank you, buddy.
Thank you.
Appreciate it. That's going to do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. And I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.